Stop chasing 30-second viral glitches that promise overnight millions, because I'll tell you how most of those stories actually end with a tax bill. A big, ugly, completely avoidable tax bill arriving in April for money that's already gone. Here's the pattern nobody posts about. The viral hack generates a quick gain. The gain gets taxed at the highest possible rates. The strategy stops working the moment it goes viral, and the person holding the bag is you, because the algorithm rewards excitement and real wealth building is boring. Meanwhile, quietly, invisibly, with zero views, the truly wealthy are doing something completely different. They're engineering disciplined, tax-advantaged architectures inside accounts the government itself created. No hype, no glitch, just structure, compounding, and a tax shield doing its job for decades. Today, we're dismantling the noise and building that system piece by piece. I'm Reza Zamani, founding partner at SteelPeak, and I want to name the real enemy in this video because it isn't TikTok and it isn't even bad information. It's the belief that wealth comes from finding something, a hot stock, a loophole, a trend, rather than building something. Finding is a lottery, building is a system. And systems win because they don't depend on luck, timing, or being early. So here's the plan. First, the math showdown. Viral hacks versus tax-advantaged compounding, head-to-head. Second, the silent killer tax drag and why social media never mentions it. Third, the fortress. The accounts that shield your money, including the single most underrated account in America. Fourth, Roth conversions. The strategic move for locking in what you know against what you can't know. Fifth, wiring it all into one automated machine. And finally, a 15-year trajectory and an audit checklist you can run on your own portfolio this week. Standard disclosure. This is education, not personalized tax or investment advice. Every example is a hypothetical illustration, and account rules and contribution limits change. So build your version with a qualified professional. Let's go. Let's have the honest comparison nobody's algorithm will show you. The viral shortcut promises speed. And occasionally someone really does hit. But study the structure of these plays and you find 3 fatal flaws. They're unrepeatable. By the time a hack has enough views to reach you, the opportunity is priced out or patched. They're undiversified. The entire outcome rides on one bet. And they're tax blind. Quick gains are typically taxed as short-term gains at ordinary income rates, the least efficient treatment in the entire tax code. Now, the boring alternative. A hypothetical investor, call her Maya, 32, contributes a portion of income a month into tax-advantaged retirement accounts, invested in diversified, low-cost index funds. No trends, no timing. At a historically reasonable long-term return, that steady portion of income a month can plausibly grow into 7 figures over a working career. And because of where it lives, the compounding happens with the tax man locked outside. Man locked outside. Here's the part that matters psychologically. At year 2, Maya looks slow compared to anyone posting a winning trade. At year 10, she's undeniable. At year 20, she's untouchable. Compounding is the only game where the scoreboard lies early and tells the truth late. Viral content is optimized for the early lie, your net worth is determined by the late truth, and understand what the trend chaser is actually competing against. Not the market, the structure. Even if the viral play and the boring portfolio earned identical returns, the boring portfolio wins because of what we cover next. Here's the concept social media almost never mentions because it's invisible and it's unsexy. Tax drag. Every year in a regular taxable account, your gains get skimmed. Dividends taxed. Interest taxed. Every profitable trade taxed. And for the active trendy trader flipping positions inside a year, those gains are taxed at ordinary income rates, which for a successful professional can mean giving up roughly a third of every win. Depending on your bracket and your state, the skim on short-term trading profits can approach 30% or more. That's the tax drag. And here's why it's lethal. It's not one bill. It's a recurring leak in the compounding engine itself. Run a hypothetical. 2 investors, identical returns, identical contributions, 25 years. One compounds inside tax-advantaged accounts, untouched. One trades actively in a taxable account, surrendering a slice of gains to taxes every single year. The ending gap between them isn't a rounding error. It can plausibly be hundreds of thousands of dollars on an ordinary professional's savings. Same market, same skill. The entire difference is structure. This is why I say the trend chaser isn't competing against the market. They're competing against a headwind they've chosen voluntarily. Every dollar lost to unnecessary tax is a dollar that never compounds again. And every dollar it would have earned is gone too. Tax drag doesn't just cost you money. It costs you the future of that money. So the transition is simple. Stop chasing temporary hype that maximizes your tax exposure and start occupying the permanent government-sanctioned fortress that was built to minimize it. Because yes, the tax code punishes speculation, but the same tax code openly rewards long-term, systematic wealth building. The instructions are printed right on the accounts. Let's tour the fortress wall by wall. The workplace retirement plan, your 401k or equivalent. Contributions typically reduce your taxable income today. Everything compounds untaxed inside. And if your employer matches contributions, that match is an immediate, guaranteed by contract return on your money that no viral trade can compete with. Priority one, always capture every matching dollar. Leaving a match on the table is declining a raise. The IRA layer, traditional or Roth. Traditional gives you the tax break now and taxes withdrawals later. Roth flips it. You pay tax on the way in, and then this is the part to sit with. Qualified growth and withdrawals are tax-free forever. Decades of compounding, the IRS never touches again. Now, the crown jewel, the one I called the most underrated account in America, the HSA, the health savings account. If you're enrolled in a qualifying high-deductible health plan, the HSA is the only account in the entire tax code with a triple advantage. Contributions go in tax-deductible, growth compounds tax-free, and withdrawals for qualified medical expenses come out tax-free. Deductible in, tax-free growth, tax-free out. Nothing else does all three. And in 2026, with healthcare costs continuing their relentless climb, here's the stealth strategy sophisticated savers use. Don't treat the HSA as a spending account. Treat it as a health and wealth investment account. A hypothetical couple maxes their HSA each year, invests the balance in index funds instead of leaving it in cash, and pays today's routine medical bills out of pocket. 20 years later, they own a six-figure, fully tax-advantaged pool aimed at the single largest expense of most retirements, healthcare. Same account everyone has, completely different outcome because they used it as architecture, not as a debit card. And the legacy wall, the 529, education money compounding tax-free for your kids or grandkids, which connects this whole system to something bigger than your own retirement. This is where systematic wealth starts becoming family wealth. One honest note, every one of these accounts has eligibility rules, annual contribution limits, the IRS updates regularly, and trade-offs around access before retirement age. That's not a flaw, that's the price of the shield. Know the rules or work with someone who does. Now, the strategic layer on top of the accounts, the Roth conversion, the concept. You take money from a traditional pre-tax retirement account, convert it to a Roth, and pay income tax on the converted amount now in exchange for tax-free growth and tax-free qualified withdrawals from that point forward. Why would anyone volunteer to pay tax early? One reason: certainty. Today's tax rates are a known number, sitting near historically low levels by long-run standards. Future tax rates are a question mark set by future Congresses facing rising deficits. Nobody can promise you rates will go up, but a conversion isn't a prediction. It's a decision to settle the bill at a price you can instead of a price you can't. When conversions tend to shine, in general terms, low-income years, a sabbatical, a career transition, early retirement before other income kicks in, where the converted dollars fill up the lower tax brackets. Market downturns converting when account values are temporarily depressed means paying tax on the smaller number and letting the recovery happen inside the tax-free wrapper. And estate planning Roth assets pass to heirs without the embedded tax liability of a traditional account, which ties directly back to the legacy conversations we've had on this channel. The caution, and it's real. A conversion raises your taxable income in the year you do it, which can bump your bracket, affect Medicare premiums down the road, and create a bill you must be able to pay, ideally from outside the retirement account. This is precisely the move you model with a tax professional before executing, not after. Done thoughtfully, often in measured annual slices rather than one giant leap, it's one of the most powerful levers in the entire system. Done impulsively, it's just a big tax bill with a good story. Individually, these accounts are tools. Connected, they're a system. Here's the unified wiring. Every payday, automatically, in order. Contributions flow to the workplace plan, up to the full employer. Match the guaranteed return first. Then the HSA, if you're eligible, the triple advantage. Then the IRA layer. Then back to the workplace plan toward its annual limit. And anything beyond the shelters flows into a taxable brokerage invested tax efficiently, low turnover index funds that don't generate constant taxable events. Notice what's missing from that sequence. You. No monthly decision, no motivation required, no scrolling for the next opportunity. The routing happens by rule, the percentages adjust once a year when your income changes, and the entire machine runs whether you're paying attention or not. That's the real dismantling of the TikTok model. Not arguing with it, but replacing the need for it. You don't chase opportunities when every dollar already has a job. Picture two hypothetical professionals, same age, same income, 15 years. One chases trends in a taxable account. Sporadic contributions, frequent trading, short-term tax treatment, a few wins, a few wipeouts, and tax drag bleeding the whole way. The other runs the machine we just built. Automated contributions, diversified funds, every dollar sheltered before it's exposed. 15 years later, the systematic investor hasn't just accumulated more, they own a structured fortune, tax-free buckets, tax-deferred buckets, a funded HSA, education accounts for the kids. The trend chaser has a brokerage account, a folder of tax documents, and stories. The gap isn't talent, it's architecture compounded. So here's your audit checklist. Pause and screenshot this. 1. Am I capturing every dollar of employer match? 2. Am I eligible for an HSA, and is it invested or sitting in cash? 3. Do I have a Roth layer, and would a conversion make sense in a low-income year modeled with a professional? 4. Is my taxable account holding tax-efficient investments or generating short-term gains? 5. Is every contribution automated, or does my system still depend on my memory? Score yourself honestly. Every no is your next move. Here's the final shift I want you to make. Stop watching daily tickers and viral plays that's entertainment wearing a finance costume. Start watching your structure, your sheltered percentage, your automation, your tax efficiency. Trends expire, architecture compounds. If this was valuable, subscribe and hit the bell. We make professional grade strategy plain every week. I'm Reza Zamani. Ignore the noise, build the fortress. I'll see you in the next one.